I mean, there are the questions about the impact on the banks, but I'm also just wondering, for investors out there, what do you do in this situation? Like, if you own residential right now, are people improving it to get higher rents as supply chains and commodity costs are normalizing? What's the right mindset to have about where there's opportunity?
I think for a lot of it, it's really playing defense, but frankly, business as usual. Certainly if you start in our multifamily portfolio, we're doing what we're doing. If we lose a tenant, we paint the apartment, we clean the carpet, we move the next tenant in. And the market, while it's softer on the occupancy side and on the rental side slightly, it's actually holding up very, very well. And I think, residential in particular has held up really well. We have a huge home building portfolio. I think everyone is shocked how well home building has done, the last couple of quarters. I think people assumed we were going to go into a massive recessionary environment in home building. We just didn't do it. And I think a lot of it was, and I said this before, it was, certainly demand has been off, but the supply is just non-existent. People are not selling their existing homes at this point, and they're sitting in them. So there's very, very little inventory out there. So I think, though it's a tale of two cities, of course, office is a completely different kettle of fish.
So what do you do with office? Is there opportunity? Where is there opportunity in the glut out there, especially as there's not as much demand for actually working in an office? What's the most likely scenario for what happens to that oversupply? Do prices come down? Do investors need to wait for that?
Yeah, I mean, it's crashing at this point. It is a flood of foreclosures. We're at the tip of the iceberg. It is going to get much worse over the next 6 months or so. I do think you have to classify real estate differently. The higher end office has actually held up really well in the major cities. The sort of B quality office, in particularly in tertiary markets, are in very, very tough shape. And look, the banks are, we were talking about the regional banks before, banks are really going to have a problem. 80% of bank lending was done by the regional banks, and a lot of it was to the office sector. But if you look at a major market, it's about $300 a foot to replace a tenant. If you don't have substantial equity in your property, why would you spend $30 million putting a 100,000-foot tenant into your building if you're really just protecting the banks? And you can't just kick the can down the road as we've done in past cycles, because you're going to end up with an office building that's completely empty. So there's going to have to be some sort of meeting of the minds between the lenders funding or taking back the properties. But office, I think it's just too early at this point. I think we're going to see a complete crash. You're already seeing some office buildings trade at 70 or 80% discounts, but that may not even be enough.
Wow. And of course, that is one of those key areas and key arguments and key focuses when we do talk about regional banks and some of the selling, for better or worse, fundamentally tied, at least at this point in time or not, around the regionals, which raises the question, what is then going to happen? Because I would imagine a lot of these banks are not going to take these properties back. And yeah, they might be opportunities for future investors who scoop them up for pennies on the dollars, but somebody's going to have to eat those losses and the cost associated with it.
Well, I think at this point, you are seeing lenders trying to work things out. If they have a good sponsor, they're trying to do it. But a lot of times sponsors are just giving, crying uncle and just giving the buildings back. There's just no reason to put time and effort into a building that's that far underwater. It's a huge drop. Operating and taxes are very high right now. There's very little marginal net profit on buildings, and the CapEx is extreme in order to keep these tenants. So you're going to end up seeing a lot of banks not wanting to take them back and starting to take them back. And again, given that 80% of the bank lending was done through these regional banks, I mean, we talked about mark-to-market losses just on interest rates. How about the fact that their collateral is worth a fraction of what they thought it was worth?
Tom Shapiro, thank you. It is good to get your insights on a day like today.